I've spent over 5 decades studying economic cycles, market patterns, and the rise and fall of empires. I've seen booms that seemed unstoppable, crashes that appeared out of nowhere, and policy decisions that altered the course of nations. But what I'm about to share with you today is something different. We are witnessing a fundamental shift in the economic order that happens perhaps once in a lifetime. The course of history has just changed, and most people don't even realize it yet. Let me start with something that should deeply concern you. Right now in the United States, we have a situation that I've never seen in my entire career. The Federal Reserve's own recession probability model is sending us a signal that contradicts almost everything we're seeing in the real economy. This isn't just confusing, it's dangerous. Because when the data stops making sense, when the models we've relied on for decades start giving us mixed signals, that's when the biggest mistakes get made. Here's what's happening. The Federal Reserve has a model that estimates the probability of a recession occurring within the next 12 months. This model is based on the yield curve, one of the most reliable recession indicators we have. Historically, this model has been remarkably accurate.
When it spikes to high levels, a recession typically follows within a year. When it drops to low levels, we see economic stability or even expansion. But today, something unprecedented is happening.
The model spiked to quite high levels in 2023 and 2024, suggesting tight liquidity conditions that should have triggered a recession. Yet no official recession occurred. And now, the model is coming back down, just like it typically does after a recession ends, even though we never had the recession in the first place. It's as if the economy is following a script, but someone skipped an entire chapter. Now, you might be thinking, well, Ray, if the recession probability is going down, isn't that good news? That's certainly what the headlines would have you believe. But let me show you why this is actually one of the most dangerous setups I've seen in my career. While the Federal Reserve's model is telling us one thing, the real economic data is telling us something completely different. Over the last few months, we've seen a string of truly horrible job numbers. The ADP job report turned negative for the first time since the pandemic. Think about that for a moment. This is a measure that tracks private sector employment, and it went negative. That means more jobs were lost than created in the private sector. Then we have the non-farm payroll report, which shows we've seen the lowest number of jobs added to the U.S. economy since the pandemic. The pace of job growth we're experiencing right now is comparable to what we saw right before the great financial crisis in 2008. It's also similar to what we observed right before the 2001 recession. These are not periods you want to be compared to. But here's what really catches my attention. The U.S. unemployment rate has risen by almost a full percentage point over the last year and a half. Now, I want you to understand how significant this is. Historically, we have never seen the unemployment rate rise by this much outside of an economic recession. Never. This is what we call the Somm rule in economics, named after economist Claudia Somm. When the unemployment rate rises by half a percentage point from its low, it has historically signaled that a recession has already begun. We're well past that threshold now. We're approaching a full percentage point increase. And yet, we're being told that everything is fine, that the economy is resilient, that we've achieved a soft landing. This disconnect between what the data is showing and what we're being told should make you very, very cautious. Jerome Powell, the chair of the Federal Reserve, has recently acknowledged that the slowdown in job creation is becoming a real risk to the economy. This is significant because central bankers are typically the last people to acknowledge problems. They have to maintain confidence in the system. So when Powell himself is saying that employment is a concern, you need to pay attention. So we have this paradox. On one hand, we have serious recessionary economic data. We have the Federal Reserve chairman acknowledging real risks. we have job growth that looks like what we see before recessions. But on the other hand, we have the Fed's own recession probability model saying the exact opposite, suggesting that we're entering a period of economic stability. How do we make sense of this? Well, I've learned over the decades that when models and reality diverge, you need to dig deeper. You need to understand what's really driving the numbers. And in this case, what's happening is actually quite clear once you understand the mechanics of liquidity and how it flows through the economy. The yield curve, which forms the basis of the Federal Reserve's recession model, is essentially measuring liquidity conditions in the financial system. When the yield curve inverts, when short-term interest rates rise above long-term interest rates, it signals that liquidity is tight. Money becomes expensive to borrow. Credit conditions tighten. And this typically precedes economic downturns. What we saw in 2023 and 2024 was exactly this pattern. The Federal Reserve raised interest rates aggressively to combat inflation. The yield curve inverted deeply. Liquidity tightened significantly. And according to historical patterns, this should have led to a recession. But here's the critical insight that most people are missing. The recession probability model is a leading indicator. It tells you what's likely to happen in the future based on current liquidity conditions. But it takes time for tight liquidity to work its way through the economy and show up in the real data. There's a lag, typically around 12 months, between when liquidity tightens and when you see the full impact on employment and economic activity. So what actually happened is this. The tight liquidity conditions of 2023 and 2024 did lead to economic weakness. We're seeing it right now in the job numbers. We're seeing it in the rising unemployment rate. We're seeing it in the corporate earnings reports that show slowing growth. The recession probability model did its job. It warned us that tight liquidity would lead to economic problems, and those problems are now materializing. But here's where it gets interesting, and this is the part that could change everything. The Federal Reserve has started cutting interest rates. They began this process in late 2024. And as they cut rates, liquidity conditions begin to loosen. The yield curve starts to normalize. And the recession probability model begins to come down. This is why the model is now suggesting we're entering a more stable period, not because we avoided the impact of tight liquidity, but because liquidity is starting to loosen again. The question is this loosening happening fast enough to prevent further deterioration in the economy, or is it too little too late? To answer this, I want you to look at the relationship between the recession probability model and the unemployment rate with a critical eye. If we shift the Federal Reserve's recession probability model forward by about 12 months, something remarkable happens. The peaks in the recession model align almost perfectly with the peaks in the unemployment rate. This tells us something profound about how the economy works. When liquidity tightens, it takes about a year for the unemployment rate to reach its peak. When liquidity loosens, it takes about a year for the unemployment rate to start improving. This lag is consistent across multiple economic cycles. It's one of the most reliable patterns I've observed in my decades of studying markets and economies. So what does this mean for where we are today? The recession probability model peaked in mid-2023. If we add 12 months to that, we get mid-2024 to early 2025. That's right now. This suggests that the unemployment rate should be peaking around this time. Now, this is actually good news if it plays out as the model suggests. It means that the worst of the labor market deterioration might be behind us.
As liquidity continues to loosen with the Federal Reserve cutting rates, we should start to see the unemployment rate stabilize and potentially improve over the next 12 months.
But, and this is a very important but, there's a significant nuance here that you need to understand. The recession probability model is still hovering around 30%. That's extremely high. After real economic recessions, when the economy is truly recovering, this model typically crashes down to near 0%. We saw this after the 2001 recession. We saw it after the 2008 financial crisis. The probability dropped to single digits, sometimes even below 5%. But today, even as the model is coming down, it's still at 30%. This tells us that while liquidity conditions have loosened somewhat, they're not loose by any means. The financial system is still relatively tight. Credit is still relatively constrained. And this means the economy is walking a very narrow path. I want to show you some additional data that confirms this view. The Federal Reserve conducts a quarterly survey of senior loan officers at banks across the United States. They ask these loan officers whether they're tightening or loosening their lending standards to corporations. This is real data from people who are actually making lending decisions every single day. What this survey shows is remarkable. Before every major recession in the modern era, we see a spike in the percentage of banks tightening their lending standards. Before the 1990 recession, banks were tightening. Before the 2001 recession, banks were tightening. Before the 2008 financial crisis, banks were tightening aggressively. And guess what? Over the past 2 years, we've seen banks tighten their lending standards significantly. This survey reached levels that historically have always preceded recessions. The tightening began in 2022 and accelerated through 2023 and 2024. Now, here's the key insight. Just like with the recession probability model, there's a lag between when banks tighten their lending standards and when we see the full impact on the unemployment rate. If we shift the lending standard survey forward by 12 months and overlay it with the unemployment rate, the correlation is almost perfect. When banks tighten lending, the unemployment rate rises about a year later. When banks loosen lending, the unemployment rate falls about a year later. This makes perfect sense when you think about it. When banks make it harder to get credit, businesses can't expand as easily, they can't invest in new projects, they have to be more cautious about hiring. And over time, this leads to slower job growth and higher unemployment. So, where are we today with bank lending standards? The survey is still showing that banks are maintaining relatively tight standards. Yes, the percentage of banks tightening has come down from its peak, but we're not seeing a significant loosening yet. The survey is still at levels that are elevated by historical standards. This tells me that while the Federal Reserve is trying to loosen liquidity by cutting interest rates, the banking system hasn't fully responded yet. Banks are still being cautious. They're still maintaining relatively tight lending standards. And this means that credit conditions in the real economy are still constrained. What does all this mean for the economic outlook? Let me give you my assessment based on all the data and patterns I'm seeing. I don't think we're going to see the unemployment rate rise substantially from here. The tightening of liquidity has probably run its course. The Federal Reserve is cutting rates. Banks have stopped tightening as aggressively. The worst of the deterioration in the labor market is likely behind us. However, and this is crucial, I also don't think we're entering an extended period of prosperity with the unemployment rate plummeting and economic growth accelerating. The liquidity conditions simply aren't loose enough for that. Banks aren't loosening their lending standards aggressively. The recession probability model is still at 30%. Credit is still relatively tight. What I expect is more of the same, a struggling muddle-through type of economic environment over the next year. Growth will be slow, perhaps 1 to 2%. The unemployment rate will probably stabilize around current levels, maybe drift slightly higher, maybe slightly lower, but it's not going to surge upward and it's not going to drop significantly either. Inflation will continue to moderate, but slowly, and the Federal Reserve will continue cutting rates, but gradually and carefully. This is what I call a low growth, low inflation, high uncertainty environment. It's not a recession, but it's not a boom either. It's a period where policymakers are trying to navigate between multiple competing risks. Cut rates too slowly, and you risk pushing the economy into recession. Cut rates too quickly, and you risk reigniting inflation. Now, you might be wondering why I titled this video, "The Course of History Just Changed." If we're just entering a muddle-through period, what's changing? Well, here's where we need to zoom out and look at the bigger picture. What we're witnessing is not just a normal business cycle. We're witnessing the end of an era. For the past 40 years, since the early 1980s, we've lived in a world characterized by declining interest rates, increasing globalization, and U.S. dollar dominance. This was the world that I built my career in. This was the world that created unprecedented wealth and prosperity. But that world is changing fundamentally. Interest rates have bottomed and are now in a rising cycle. Globalization is reversing as countries prioritize national security and supply chain resilience. And the U.S. dollar's role as the world's reserve currency is being challenged in ways we haven't seen since the Bretton Woods system was established after World War II. The signals we're seeing in the Federal Reserve's recession model, in bank lending standards, in the labor market, these aren't just cyclical fluctuations. They're symptoms of a deeper structural shift that's occurring in the global economy. We're transitioning from one economic order to another. And these transitions are always messy, always uncertain, and always create opportunities for those who understand what's happening. Let me give you some specific examples of what I'm seeing. First, the relationship between monetary policy and the real economy is changing. In the old world, when the Federal Reserve cut interest rates, money flowed freely through the banking system and into the real economy. Credit expanded, asset prices rose, economic activity accelerated. This was the playbook that worked for decades. But today, even as the Federal Reserve cuts rates, we're not seeing the same response. Banks are remaining cautious. Lending standards are staying tight. The transmission mechanism from monetary policy to the real economy is impaired. This is what happened in Japan in the 1990s and 2000s. They cut rates to zero, even went negative, but credit didn't expand because banks were dealing with bad loans and businesses were dealing with excess debt. We're not at that extreme yet in the United States, but we're seeing early signs of a similar dynamic. The effectiveness of monetary policy is diminishing. This has profound implications for how we should think about investing and risk management going forward. Second, the inflation dynamics are changing. For 40 years, we had persistent disinflationary pressures. Technology, globalization, and demographics all push prices down. Central banks could print money aggressively without causing sustained inflation. We saw this after the 2008 financial crisis, when the Federal Reserve expanded its balance sheet massively, yet inflation remained subdued. But today, those disinflationary forces are weakening. Deglobalization is inflationary. Supply chains are being reorganized for resilience rather than efficiency, which is more expensive. Demographics are shifting as populations age, creating labor shortages in many developed countries. And we have massive fiscal deficits that are being monetized, which is inherently inflationary. The inflation we experienced in 2021 and 2022 wasn't just a temporary pandemic-related phenomenon. It was a warning shot. It showed us that the old rules about inflation being dead are no longer valid. We need to prepare for a world where inflation is more volatile, more persistent, and more difficult to control. Third, the geopolitical order is shifting in ways that have enormous economic implications. The relationship between the United States and China is fundamentally changing from cooperation to competition, potentially even conflict. This affects everything from trade flows to technology development to financial markets. We're seeing the emergence of competing economic blocs. The United States and its allies are forming closer economic ties, often explicitly excluding China. China's building its own network of economic relationships through initiatives like the Belt and Road. We're moving from a unipolar world dominated by the United States to a multipolar world with multiple centers of power. This geopolitical shift manifests in the economic data we're seeing. The tight bank lending standards aren't just about normal credit cycle caution. They reflect uncertainty about the future regulatory environment, about trade policy, about geopolitical risks. When banks don't know what the rules will be or where the conflicts might emerge, they become more conservative with their capital. Similarly, the strange behavior of the recession probability model reflects the fact that the economy is being buffeted by forces beyond just domestic monetary policy. Fiscal policy is extremely expansionary with large deficits. Geopolitical tensions are creating supply shocks. Technology is disrupting traditional business models. All of these factors are making the traditional economic relationships less reliable. So when I say the course of history has changed, I mean that we're entering a new paradigm. The economic playbook that worked for the past 40 years needs to be rewritten. The assumptions that guided policymakers and investors are no longer valid. We need new frameworks for understanding how the economy works. What does this mean practically for how you should think about the economy and your investments? Let me share some principles that I believe will be critical in this new era. First, diversification is more important than ever. In the old world, you could make a lot of money by being concentrated in U.S. stocks and bonds. The 60/40 portfolio worked beautifully for decades. But in this new world, with more volatility, more inflation risk, and more geopolitical uncertainty, you need broader diversification. This includes international exposure, commodities, real assets, and alternative strategies that can perform well in different economic scenarios. Second, you need to be more tactical and adaptive. The old buy and hold approach still has merit, but you also need to be able to adjust your positioning as conditions change. When we see tight liquidity conditions and rising recession risks, you want to be more defensive. When we see liquidity loosening and growth improving, you want to be more aggressive. This requires paying attention to the indicators I've discussed, the yield curve, bank lending standards, employment data, and being willing to act on what they're telling you. Third, inflation protection becomes critical. For 40 years, investors could largely ignore inflation. It was low and stable. But in this new era, you need assets that can maintain their value when prices rise. This includes commodities, real estate, inflation-linked bonds, and certain types of equities that have pricing power. Fourth, you need to understand that cash is not as safe as it once was. Yes, cash provides stability and optionality, but in a world of persistent inflation and negative real interest rates, holding too much cash means watching your purchasing power erode. You need to keep your capital working, but in ways that are appropriate for the risk environment. Fifth, and perhaps most importantly, you need to develop a deep understanding of how the economic machine works. You can't just follow the headlines or rely on what everyone else is doing. You need to look at the underlying data, understand the relationships between different economic variables, and think independently about what it all means. This is exactly what I've been trying to do with the Bridgewater principles and the economic machine framework. I want people to understand not just what's happening, but why it's happening. When you understand the mechanics, you can anticipate what's coming next and position yourself accordingly. Let me bring this back to where we started with the Federal Reserve's recession model. The signal we're seeing right now, with the model coming down even as economic data remains weak, is telling us something profound. It's telling us that we're in a transition period. The old tightening cycle has run its course. Liquidity is beginning to loosen, but we're not yet in a new expansion. We're in the messy middle. This is actually a very important time to be paying attention. Transitions create opportunities. When most people are confused about what's happening, when the signals are mixed and the path forward is unclear, that's when the biggest opportunities emerge for those who can see clearly. Right now, most investors are positioned for one of two scenarios. Either they believe we're heading into a severe recession and they're very defensive, or they believe the economy is fine and they're fully invested in risk assets. But the truth is probably somewhere in between. We're likely to see a period of slow growth, moderate inflation, and continued policy uncertainty. In this environment, the winners will be those who can navigate complexity, who can be nimble, who can see opportunities that others miss. It's not about being all in or all out. It's about being balanced, diversified, and ready to adjust as conditions evolve. The labor market data will continue to be critical. If we do see the unemployment rate peak and start to improve, as the model suggests, that would be a positive signal. It would suggest that the Federal Reserve's rate cuts are working, that liquidity is flowing back into the economy, and that we can avoid a deeper downturn. But if the unemployment rate continues to rise, if we break above 5% and keep climbing, that would be a very concerning signal. It would suggest that the damage from tight liquidity is more severe than anticipated, that the Federal Reserve is behind the curve, and that a recession is becoming more likely despite what the model is saying. I'm watching the Bank Lending Standards Survey closely as well. If we start to see a significant decline in the percentage of banks tightening, if the survey drops below zero, indicating that more banks are loosening than tightening, that would be a very positive signal for the economy. It would mean that credit is starting to flow more freely, that the real economy is getting the support it needs to grow. But if lending standards remain tight, if banks continue to be cautious despite the Federal Reserve cutting rates, that tells us the transmission mechanism is broken. It tells us that monetary policy is less effective than it used to be. And it tells us that we need to be prepared for a longer period of subpar growth. The geopolitical situation also bears watching. Any escalation of tensions between major powers, any disruption to global trade, any major conflict, these could all derail the tentative stabilization we're seeing. In today's interconnected world, a crisis anywhere can quickly become a crisis everywhere. I also want you to pay attention to fiscal policy. In the United States, we have massive budget deficits running at over $1 trillion dollars per year. This fiscal expansion is actually supporting the economy right now. It's one reason why we haven't seen a more severe downturn despite tight monetary policy. But this fiscal situation is unsustainable. At some point, there will need to be a reckoning. When that happens, it could create significant economic and market volatility. The most important thing I want you to take away from this is that we are living through a historic transition. The economic order that defined the post-war era, that created unprecedented prosperity, that seemed permanent and unchangeable, is evolving into something new. We don't yet know exactly what that new order will look like, but we can see the contours taking shape. This transition will create winners and losers. Those who cling to the old playbook, who assume that what worked before will work again, will struggle. But those who can adapt who can see the new patterns emerging, who can position themselves for the new reality, will thrive. I've been through many transitions in my career. I saw the end of the Bretton Woods system in the 1970s. I saw the shift to globalization in the 1980s and 90s. I saw the rise of China as an economic superpower. Each of these transitions was disorienting at the time. The old relationships broke down. The old strategies stopped working. Many people lost fortunes because they couldn't adapt. But I also saw how these transitions created incredible opportunities. The investors who understood what was happening, who positioned themselves correctly, made generational wealth. The businesses that adapted to the new reality became the dominant companies of their era. The countries that embraced the changes prospered while others stagnated. We're at another one of these inflection points right now. The Federal Reserve's recession model, the bank lending data, the labor market numbers, these are all pieces of a larger puzzle. They're telling us that something fundamental is changing. The course of history is shifting. The question is, are you prepared for it? Do you understand what's happening? Are you positioned to navigate this transition successfully? Or are you still operating based on assumptions that no longer hold true? This is why I spend so much time studying history, studying patterns, studying the mechanics of how economies and markets work. Because when you understand the machine, when you can see the cause and effect relationships, you don't have to be surprised by change. You can anticipate it, you can prepare for it, you can profit from it. The Federal Reserve's recession model, coming down while economic data remains weak, isn't a contradiction, it's a signal. It's telling us that we're in transition. The tightening phase is ending, the loosening phase is beginning. But we're not yet in a new boom. We're in the uncertain middle, where the old is dying and the new is not yet born. This is a time for clear thinking, for careful analysis, for strategic positioning. Don't let the noise distract you. Don't let the headlines scare you or give you false confidence. Look at the data, understand the relationships, think independently, and position yourself for the world that's coming, not the world that was. Thank you for taking the time to understand these complex dynamics with me today.
The insights I've shared are based on decades of experience studying markets and economies. They reflect principles that I believe are timeless, even as the specific manifestations change.
Stay curious, stay informed, and most importantly, stay adaptable. The world is changing, and those who can change with it will be the ones who succeed.